Shares of Amazon stock are down 35% from its all-time high. Amazon shares have only traded off more than 35% 6 times in the company's history. Is this business falling apart, or is this actually a great buying opportunity? In today's video, I'm going to tell you exactly why I'm buying shares today. And I'm going to talk to you about two parts of Amazon's business that I think are completely misunderstood. They're going to drive Amazon's path forward. Portfolio is at about $35,000. We've put in 38,500, so we're still down 3,700. This shows minus 29%. It's based on money weighted return. Obviously, 3,700 is not 30% of 3,400. It's just how it's working out. So not concerned with it. It's been a tough period. If you're feeling it, I know how you're feeling. Anyways, here's the largest position. So I want to give you this update. Amazon 6,300, and that does not count the 1,500 more that we're adding today. Why are we doing that? I feel like people are panicking about Amazon. They're saying the business is horrible, and I'll get into more details. I don't think the business is falling apart. In fact, I think there's a lot of strength that they have with their scale. It's an incredible business. Again, I'll get into this. And so I am front loading a lot of what I intend to be my purchases of Amazon, because I feel like this is when there's the most fear. Company's not going away. It's not at an existential risk. And I want to pile those shares up now at what I believe is a discount when everybody's freaking out. So it will not remain, I'm not going to keep adding and adding and adding to it. I'm building it up here and might add to it if, again, another 1,500 or so if it's very opportunistic. But this is getting towards, after today and maybe one other purchase, it'll be at the top end of kind of the size I want that position to be at this point in the portfolio with, again, I'm still adding every month. So I'm okay with positions being a little bit larger. GitLab next up, 4,600, Tesla, 4,100, Snowflake, 39. Okay, so we have one buy coming in. And I just will show you that that's going to be one buy. It's going to be Amazon for $15.25. It's going to happen here in the next few minutes when the market opens. Here is Amazon's Q1 2022 earnings call. And I've just highlighted some things that I want to cover real quick. And then we'll get into fast graphs and why I think Amazon is an incredible value. Okay, so this is Brian T. Olzowski. Probably said that wrong. Senior VP and CFO. All right. Here's his prepared remarks. Worldwide net sales in Q1 were 116 billion, increase of 9% year over year, excluding the impact of foreign exchange. This is the top end of our guidance. Compound annual growth rate since the pandemic is at 25%, a growth rate higher than what we were seeing before the pandemic. So we saw the headlines last week where CNBC and everybody, all the clickbait was saying Amazon growing the slowest rate since the 2000. Well, they are growing at a 25% compound growth rate on $116 billion in quarterly revenue. Come on, that's not a failing business. And it's amazing that they're growing that fast at that scale. This is big for me and my thesis. Prime members continue to be a key driver of growth. Prime members have meaningfully increased their spend since the start of the pandemic, and we continue to see consistently high member renewal rates. We also added millions more new Prime members during the quarter. So Prime is a key driver, and they are adding millions more new Prime members during the quarter. That member base is still growing. That is, in my opinion, recurring subscription revenue, essentially. We continue to face a variety of cost pressures in our consumer business. That's what all of this fear, or a lot of this fear, is about, was the cost pressures and then slowing growth. They put that in two buckets. Externally driven costs, primarily from inflation, and internally controllable costs, which is from productivity and fixed cost deleverage. I think we have an idea of what that external stuff is. Inflation, gas prices rising, logistics prices rising, things like that, inflation based. The productivity and fixed cost deleverage is they have had to, because of COVID, because of all the unpredictability in the workforce and people being out, even when they hired them, they were out with COVID or possibly with COVID or whatever. They had to overhire to make sure they could meet that demand. And that meant going too far and overhiring and spending more money than they needed to keep the quality of service that they needed to keep Prime members happy and to keep the level of service people expect from Amazon and to keep growing Prime. And they took that short-term hit. This is a long-term mindset to keep that brand. They took that short-term hit knowing that it's going to keep their brand. They're going to build out this infrastructure. they're in a position where they could do it. Sure, the stock price might get hit, but the business is not at risk, in my opinion. And they just took that up front, and now they're going to manage it and even it out over time. I believe they can manage it. They've done it for 2 decades now. I think they will. Okay, so on to guidance. The guidance includes an expectation that we will incur approximately $4 billion of these incremental costs in Q2. In Q1, it was about $6 billion. So Q2, it's coming down about 30%. We saw another strong quarter of innovation and customer engagement in AWS segment, where net sales were $18.4 billion in Q1, up 37% year over year, and now represent an annualized sales run rate of nearly $74 billion. A lot of criticism for this, but AWS, I'm saying I get a lot of criticism for thinking about AWS this way, but I don't care. There's just trolls out there that are probably unhappy with themselves, so they need to pick on other people. AWS segment, $18.4 billion, $74 billion annual run rate, growing at 37% year over year. That's up there with, top quality SaaS or platform as a service businesses that are out there today that are getting price to sales multiples, which are questionable, and everybody criticizes them, of 15 to 20 to even 22 at this point. And so when you factor in AWS as a mix of Amazon's other businesses, including advertising, which is growing strong, and you think about the multiples put on these different business segments, and we'll get to it in fast graphs again to show the actual numbers, but that's why I think that this is a great time to buy, because the sum of all these businesses is, in my opinion, higher than what the current share price and market cap of Amazon is, or at least the sum I think it deserves and will get over time. For the full year of 2022, we do expect infrastructure spend to grow year over year, large part to support the rapid growth in AWS. We like that. They're still seeing opportunity in growing AWS. Consumer business, they have excess capacity in the network that they need to grow into. So we've brought down the build expectations. Many of the build decisions were made 18 to 24 months ago when there was a ton of uncertainty with COVID. So there are limitations on what we can adjust mid-year. That is a downside to Amazon's business at this scale. It's essentially like turning an aircraft carrier. It just takes a long time to make these adjustments. And so that is a downside. They do have a high cost structure. But I think that there's enough positives about the business, and they're managed well enough, and it's got a powerful enough brand and enough scale that those cost requirements, those capital requirements, aren't destructive to the business. They've hurt short term, but it's not, in my opinion, a huge risk. Finally, I'll highlight a few additional items. Overall net loss of $3.8 billion, which got a lot of headlines. While we were primarily focused our comments on operating income, I'd point out that this net loss includes a pre-tax valuation loss of $7.6 billion in non-operating expense from the common stock investment in Rivian Automotive. You may remember they had a $12 billion gain on Rivian in Q4. So we also provided second quarter financial guidance as part of our earnings release. As a reminder, our comparable period of Q2 21 included continuation of extraordinary net sales growth. Again, why is Amazon set to grow so slow? They're lapping pretty challenging quarters, and they have a ton of scale and size that they're trying to grow off of. Through roughly the first half of that quarter, that began to moderate in the second half as vaccines became more readily available in many countries and people started getting out of their homes. In addition, so this is another thing, Prime Day will occur in the third quarter in July. And last year, it occurred in the second quarter. So they are comparing to the second quarter of last year where they had Prime Day, which bumps contribute about 400 basis points, so 4% to the Q2 year-over-year revenue growth rate. So there you go. That's going to be a 4%-ish bump in Q3 that they're not getting in Q2. Okay, let's jump down to the questions, and we'll just cover these quickly. Just a few here I wanted to cover, and these are just comments from the CFO. The question was essentially on capacity and then inflation and expenses. So we're working on it. As we progress, there's only guidance for Q2, but what we see is that fixed cost deleveraging will narrow as we go through the year, and we'll be really glad we have this capacity in Q3 when Prime Day hits, because that's always a big surge of both inventory and orders then through the holiday season. So the way we see it is we've come out of a very tumultuous 2 years. We're glad we made the decisions we made over the past 2 years, and now we have a chance to more right-size the capacity and normalize the demand pattern. And then here's the thing. So in Q1, literally, revenue was 61% higher over 2 years from 2020. Back to those headlines about Amazon slowing and being, the slowest growth rate since the dot-com bust. Revenue was 61% higher you're talking over $100 billion now than from 2 years ago. That's pretty amazing. They think it's going to resume at a more normal growth rate going forward, but I wouldn't be fooled by the revenue growth rate in this difficult period. So management is, they're saying what their opinion is right there. Okay, and last question. This is a good question. It was on AWS backlog and advertising. So 2 questions. Can you talk about advertising? And then the second, I don't think AWS backlog was asked. We're continuing to see what the backlog is. It's the increase of AWS customers making long-term commitment for AWS. At the March period ended, we had 88.9 billion balance for that. So that's up 68% year over year. And the weighted average remaining kind of life term for those is 4 years. $88 billion in backlog. So that is revenue that is planned to be spent that they've already essentially signed. $89 billion in the life is about 4 years. And so they'll obviously get, more revenue over that time, but that's what they've already got in backlog. Advertising was up 25% year over year, growing very nicely. And that's a strong run rate compared to the revenue growth rate. So we're still very happy and pleased with the way the advertising team is performing and how advertising has been valued by both sellers and vendors and others who use it to reach our customer base at the point where they're considering purchases. So a strong quarter continued to roll out new products for sellers to manage their advertising and increase the ability to analyze, calculate the payback on marketing. Let's jump into fast graphs. I believe operating cash flow is a better way to value this business or to think about this business. Since 2011, the average price to operating cash flow ratio has been 26. They have grown operating cash flow on average at 30% per year. Right now, it's trading down to a blended price operating cash flow of 23. Analysts, and maybe these come down, who knows? Analysts are expecting operating cash flow to grow 62%, 42%, and then 26%. So even if we take it out to a 26 over the next 3 years, you're looking at an annualized return of 45%. But what if we don't think it's worth that? What if we think the price operating cash flow ratio should be 20? Then you're still looking at a 31% annualized return, even down to a price operating cash flow ratio of 14. You're looking at a 16% annualized rate of return. Maybe it's not worth that at all. Who knows? I think it is. Maybe they missed these numbers, so that could come down. But if we look historically, when was the last time it traded at a price to operating cash flow ratio of under 20? Let's find out. So right here, 2016. So from 2016 to pre-COVID, when it got back up to a price operating cash flow ratio of 25, you're looking at a 40% annualized rate of return. Maybe that doesn't happen. Maybe maybe people decide it's worth less. But I feel pretty good about that margin of safety there. And then if we wanted to go to price sales ratio, the thing that I'll point out with price sales ratio is right now it's trading at a blended price sales according to FastGraphs data and the way they do this metric at 2.6. Let's see when else it has traded at a price sales ratio of 2.6. So really back in 2016. And so their growth was, 16% revenue, 25, 28, and 29. And so even if you just kind of stick it where it was trading at a price sales ratio of 2.8, you're still looking at a 36% annualized rate of return. Let's say we don't think it's going to be worth a price sales ratio of 2.6, but our time horizon is long enough. Let's bring it out to 2.2. So that's a 20% reduction in multiple compression from these levels when it's already down so much. You're still looking at a 10% annualized rate of return over the next 3 years. So in my opinion, the news flow is about as bad as it could be in Amazon, and the sentiment is about as bad as it could be. People are just writing off this business, and you can really get in trouble by catching falling knives and trying to invest in turnaround stories. In my opinion, Amazon is not a turnaround story. It's a business that got overvalued during COVID. It had really never traded at a price, we're just using price sales, had never traded a price sales ratio this high before. it just got way overvalued. That was the problem. And now it's traded off. And now, in my opinion, it's swung back too far the other way. And I think that this is a wonderful opportunity. If we're not to minimize the loss that people have had, I get that that's real, that hurts. But if we're adding new money and looking to build a position, in my opinion, this is a gift for the future because we're getting to buy Amazon at a valuation that it's rarely traded at in the past. And when it has, it's been times of extreme fear, and people have made really great returns moving forward. Is that guaranteed? Nope. But I'm certainly comfortable having a large position in as secure, in my opinion, of a company as Amazon, because I believe they're going to turn around, and AWS, advertising, and then even the retail business will continue to do well from here.